Hello, college accounting scholars. Hey, we're going to get into some deep stuff here today. We're going to talk about things like LIFO and FIFO, and you accounting one scholars might recall those terms, but we are going to go into in depth here. They're relatively simple concepts, but you really need to make sure you understand what the logic are behind them. So let's start talking about why why there are cost flow assumptions and why they are necessary. Well, first of all, the cost flow assumptions are a way to use to assign costs to cost of goods sold and the ending inventory accounts. The reason these are done is that it basically saves the company time and trouble of identifying each individual item in inventory. So this is a relatively organized way to handle these particular accounts. Now, you're going to hear terms here quite frequently over the next several sections. One is called FIFO, which refers to a way to account for inventories and cost inventories, and the other is LIFO. So FIFO stands for first in, first out. Basically, it means that the first costs that are recorded in the inventory account are the first costs that are going to be used in the cost of goods sold. So that's FIFO. LIFO stands for last in, first out. And that essentially means the last costs that are recorded, the last in, are the first costs expensed in the cost of goods sold. So, it's important to make sure you differentiate in your mind and don't confuse cost flows with product flows. A company will use LIFO, or a company that uses LIFO is not necessarily selling the latest items purchased. It's merely assigning the most recent costs to the cost of goods accounts. It really is a timing issue only. So you want to keep that in mind so that you don't get confused. One of the things you might remember back in our coffee business plan is we made the assumption in our coffee business plan that we were employing a just-in-time inventory method. Essentially, we were getting material in at the beginning of the month, coffee, condiments, things of that nature, cups, and we were essentially depleting that inventory by the end of the month. So we really didn't have these FIFO, LIFO issues. So that was a classic example of why, when a company uses just-in-time, that these don't necessarily apply. But in some cases, there may be small amounts of inventory left over in a just-in-time company. It's not perfect. We had a theoretical model for our business plan. So even in a just-in-time case, sometimes there will be small amounts left over, and the company must determine the appropriate cost flow. Before we leave this slide, I want you to use illustration on the bottom right corner as a way for you to understand the LIFO FIFO approach. And as you can see, the items, the boxes are color coded to represent an inventory account. So in the inventory account, you can see that the yellow item came in first, the green item second, and the purple item third. In the LIFO scenario at the far right, it would be based on the last in item, and you can see that the purple item is the one that would be used for product costing. The green would be second, and the yellow would be third. However, in FIFO, which is first in, first out, as you can see, since the yellow was the first one in, that would be the one item, whatever the cost associated with that would be used for costing, then the green item, and then the purple item. So kind of get that illustration in your notes to have a better understanding of FIFO and LIFO. All right, so let's start taking an actual example here, and this is pretty straightforward. Let's say on March 1st, the beginning inventory was 10 units with a cost of $5 each. On March 3rd, you actually purchased 12 units with a cost of $6 each. Now you see there's a difference in the cost of the items in inventory. March 1st, we had beginning inventory of 5. March 3rd, we paid a little bit more of 6. On March 5th, we sell 15 units. So under the FIFO method, what would be the math associated with calculating the cost of goods sold? So under the FIFO method, it's first in, first out. Since the first in was the $5 item, which was the beginning inventory on March 1st, it's 5 times 10. And then you have some additional units which are associated with the March 3rd purchase at $6. So the cost of goods sold would be $80. Now let's look at the LIFO method. And you can see the math is a little bit different. Since it's last in, first out, the items that would be used first would be essentially the March 3rd items, which are $12 times 6, and then it would go back to the prior items that were received earlier on March 1st, and then we would have $3 times 5, or $87. So as you can see, depending upon the method used by the company, you will have a different costing structure. All right, guys, have a great night. We'll see you